Hello folks, and welcome to my discussion on perpetual versus periodic inventory systems. In this example that we're going to work our way through, I'm going to assume that you have read the material in the textbook regarding perpetual and periodic inventory systems, and we're now going to complete a student handout on the perpetual system. If you open your student handout on perpetual versus periodic system, you'll see the perpetual system is a column on the left-hand side. I would like you to complete all journal entries working down that column on the left-hand side for the perpetual inventory system, and then to return to this podcast for a discussion on that. Then you'll go back to your handout and complete the journal entries on the right-hand column for a periodic system, and then return to this podcast for a discussion and a summarization and comparison of the two methods. So, let's get started first with the perpetual system. Are you ready? So, the first thing we'll do is to work our way through the perpetual system. You were asked to record a purchase of 100 units at $20 each. 100 times 22,000, and since we're using the perpetual inventory system, you debit the purchase to inventory. You were then asked to pay a freight bill for $200 cash. Any costs incurred getting the inventory in place and ready for its intended use would be included in the inventory account. Then you were asked to record a return of those 20 units. 20 times 20 is 400. You would take it out of accounts payable and out of inventory. Once again, all costs associated with inventory are kept in the inventory account real time. Some inventory left, and so you would show it as gone. You were then asked to record payment with a 2% discount. Let's move on to that journal entry. I think the first thing we might do that would be useful is figure out what amount you have in the accounts payable account as it relates to the purchase of this inventory. You'll recall you purchased $2,000, but you returned $400 worth, and so in accounts payable you currently have $1,600. So you would need to remove that from the accounts payable account, and that shows you how we came up with that amount. Recall you have a 2% discount, so you could take 2% off of this and pay that much less. 2% of $1,600 is $32. Notice that also comes out of the inventory account as a reduction of the price of the inventory, and the difference is a credit to cash. In our last journal entry, you were told to sell 40 units at $30 each. 40 times 30 is $1,200, and you sold it for cash. So we would record the cash and the sell. Then comes the cost of goods sold. In our example, I'm going to use an average inventory cost. You had $2,000 that you accumulated when you purchased it. You had $200 freight. You returned $400. And you took a discount. All of those things are running through inventory. Divide that by the 80 units you had left, and then times it by the 40 you sold, and you'll come up with the 884. So in summary, when you're looking at the perpetual system and you're looking at the inventory account, everything that affects inventory is ran through it in real time. You put your purchase in inventory. You put your freight in inventory. You took out your return, and you took out your discount. All of these costs are running through the inventory account. And if you total that, you'll see you'll have, I think it's $1,768 in inventory, and you just sold half of it. That concludes my discussion on the perpetual system. It's now time for you to go back to your handout, complete the column on the periodic system on the right-hand side of that worksheet, and then come back to this video or podcast, and we'll have a discussion on just the perpetual method. Then we'll finish up with the summarization by comparing the two. Put me on pause, get that done, and then come on back. Let's get started now on the periodic method. First, you record the purchase of 100 units, $20 each, and so in the periodic method that gets put in a purchases account. Interesting. Purchases is an expense account, so it's almost as though from the very beginning you assume you're going to sell all of it. That gets you closer to a good estimate on your income statement than not having any expense related with the inventory, but it's not good matching, so we're going to have to clean this up at the end. But purchases is an expense and you just debited it for the purchase of the inventory. When you pay transportation or freight in, you record that in an account so appropriately named. And this relates just to the cost of getting the inventory to you, ready for its intended purpose. When you return 20 units at $20 each, take it out of accounts payable and you record it into purchase returns and allowances, a contra account for inventory purchases, a contra expense account, and it's contra to purchases, so you've now decreased your expense, if you will, by the amount of the return. When it comes time to pay the discount, the entry is calculated the same as we did with the perpetual, but notice that the debit comes out of accounts payable for the whole amount. That's the same, but this time the discount isn't taken out of inventory. It's put into an account appropriately named purchase discounts. It's another contra expense account. And finally, you record the sale. When you record the sale, you just record the sale. There was no cost of goods sold because remember, you've expensed everything that you've purchased. All freight that you've incurred on bringing the inventory in, you've reduced it for any returns and allowances and any discounts, but all of that is sitting on your income statement. That isn't correct because we didn't sell all 100 units. We only sold 40, so it requires an adjusting entry at the end of the accounting period. And the adjusting entry is where, excuse me, I'm not very good at this yet. The adjusting entry is where you get everything back into balance. Cost of goods sold is kind of a plug. You leave this blank, but you are going to put an amount in there at the end. First, you need to zero all of the accounts in kind of a mock closing that affected what you did with this inventory. I'll start a little out of order. I'll do it in the way it happened. We need to zero the purchases. We need to zero the transportation in. We need to zero purchase returns and allowance, the contra purchase account. Then we take a discount. We need to zero that. We had no beginning inventory, or I would also be zeroing that number. And then we set up our ending inventory. We go out and do a physical count, and we find we have $884 worth of inventory left, or those 40 units, and we put down their cost. So by including beginning and ending inventory in this journal entry, we capture the change in inventory, which is what we're after. And then we net all of those numbers and find out that if you total this journal entry, we're out of balance by $884, so that would be the amount of cost of goods sold for the period. This adjusting entry is extremely efficient. It's a mock closing for all the accounts that affected that purchase returns of inventory, and it collects them all, captures the change in the inventory account, and puts it into cost of goods sold. Another way to look at that is to remember that under the periodic system, inventory is only updated periodically. It started at 0, it ended at 884, just happens to be the same amount of cost of goods sold because I sold half. And when it ended at 884, we need to back $884 out of the cost of goods sold, or out of the purchases for the period to get cost of goods sold right. By setting up the ending inventory in 884, we in fact make this number smaller by that amount, and it accomplishes what we mean to do. Take a look at the resulting income statement. we have our cell. We list that. This is your standard periodic inventory statement. Here's your cell, and cost of goods sold is calculated as beginning inventory plus purchases less any returns and allowances and discounts. That's your net purchases. Add transportation in, and all of that together is total goods available for the whole period. Subtract out the ending inventory from a physical count, and you'll have cost of goods sold equaling 884. 1200 minus 84 equals gross profit on this method of 316 if you look at the income statement. And the physical count shows 40 units at 22.10 each, reflecting an average cost flow method. So those are the journal entries as they are used to show what happens on a periodic system. And notice everything goes into an account that's appropriately named. Purchases, transportation in, purchase returns and allowances, purchase discounts, and then all of those closed and netted against each other along with the change in the inventory account to force an entry into cost of goods sold. That's an adjusting entry, and it needs to be made in the same period so that the income statement is correct. Now, let's do a comparison of all of this. And we're ready to look at the entries side by side. We'll start with the perpetual. Please note that when you're looking at the perpetual, let me get as much showing as I can. When you're looking at the perpetual system, inventory is kept perpetually up to date. You add any purchases to the inventory account. You add any incidental costs directly related to inventory into that account. You remove any returns. And then if you're good and lucky and sell some inventory, you immediately remove it when you calculate cost of goods sold. So inventory is kept perpetually up to date. When you look at an income statement for that, the sales were 1,200, the cost of goods sold were 884, and gross profit in this example was $316. Now let's compare that to using the periodic system of calculating inventory. So looking at the periodic, you'll notice that purchases are expensed and put into an expense account called purchases. I'm not very good at this, am I yet? They're put into an account called purchases. Transportation is put into an account called transportation in. Purchase returns and allowances are in a contra expense account. There I go again, pressing too hard. Purchase returns and allowances. When you take a discount, it goes into another contra expense account called discounts. And then when you record the sale, there is no cost of goods sold entry. My goodness, you've expensed everything to date. Expensing everything to date isn't correct because we haven't sold everything, so we need to make an adjusting entry at the end of the period before the financial statements are prepared, or they're just incorrect. And in that adjusting entry, we do a mock closing of everything that affected inventory by netting it into cost of goods sold. We record the purchases. Go away. We record the purchases. We record the transportation in. We record the purchase return. We recorded the purchase discount into those accounts. And so I zero all of those into what's going to become cost of goods sold. Then I need to capture the change in inventory. So I would subtract whatever beginning inventory was and set up ending inventory. And this would put the right balance in my inventory account. And notice the only thing that runs through the inventory account on this method is it was at 0. It got set up for 884, and at the end of the period it's at 884, exactly where it was on the perpetual system. The perpetual system showed inventory of the purchase, the freight, the return, the discount, the sell, and if you net all of that, it's also at 884. So there's no difference in the balance in the inventory account between the two methods. The only difference could be caused by cost flow. And when you compare the income statements, you'll see we're at the same place. Under the perpetual method, we just have one number for inventory cost, and that's the 884 from our cost of goods sold entry, leaving us with 316 of gross profit. When you look at the income statement for the periodic system, you have the sale. You can show the detail, which is the purchases less discounts and returns and allowances and freight, total available minus the sale, cost of goods sold, sales minus cost of goods sold, same gross profit as with the perpetual method. You can show the detail, or you could just show 884 as cost of goods sold and ending inventory. So that's a good description of how you can compare the periodic to the perpetual systems. Hopefully you found that interesting and learned some things from that, and are better able to complete your homework and understand the differences between the two. Thanks so much for joining me. Bye for now.